Bismillahirrahmanirrahim. In the previous class, we discussed about financial statement analysis in detail. We discussed about the definition of financial statement analysis, that what is financial statement analysis. Then after that, we discussed about who is interested in financial statement analysis. Then we discussed about pre-awareness of financial statement analysis, sources of information for financial statement analysis. Then we discussed about methods of financial statement analysis, importance of financial statement analysis, and different other things. Today, one topic was left in the previous class, that was the limitations of financial statement analysis. Now, what are the limitations of financial statement analysis? The first limitation of financial statement analysis is the limitations of financial statements. There are lots of limitations of financial statements. When you will study the limitations of financial statements, then you will see that there are lots of limitations, weaknesses in financial statements. And when there are weaknesses in financial statements, these weaknesses of financial statements will also be the weaknesses of financial statement analysis. So the first limitation of financial statement analysis is the limitations of financial statements. There are lots of weaknesses in financial statements, and these weaknesses of financial statements becomes the weaknesses of financial statement analysis. The second weakness of financial statement analysis is window dressing. What is window dressing? Window dressing means something is bad and you want to show it good. Inside that thing, nothing is good, but outside it is looking good. We call it window dressing. So sometimes accountants, what are they doing? They are trying to show the facts good, but basically these facts are not good in the financial statements. Like suppose this is a financial statement. Now in this financial statement, suppose there are lots of bad things. But what accountant did, he tries to show these things good. This is called window dressing. When accountants tries to hide the facts, to show the bad things looking good, we call it window dressing. So if there is a window dressing, so then the analysis that we made from financial statements, this analysis will also be a weak analysis. In window dressing, like one example is that we are showing closing stock high. When we will show closing stock high, what will be the benefit? It will show high profits and a lot other benefits. There is no closing stock, but we show it high. So this is what? This is a type of window dressing. So I'm telling you that window dressing is financial statements are not good. The information within the financial statements are not good, but the accountant, he is trying to show these things good. He's hiding the facts. We call it window dressing. When he shows, when he hide the things, so the analyst who is making financial statement analysis, he will not get the exact analysis. So this is also a weakness of financial statement analysis. The third limitation of financial statement analysis is it ignores the price level changes. What does it mean? Suppose this is financial statement of 2018 and this is financial statement of 2019. In 2018, the prices were different. In 2019, due to inflation, the prices are different. You know, there is inflation in Afghanistan. So, because of this thing, now, what is the problem in price change? The problem is in 2018, if the price is low and our sales it was suppose $1 million. Suppose at that time the unit price was $10 or 10 Afghanis. Now in 2019 the price goes up or it can come down. Suppose the price goes up to 11. But there is also another thing, that is cost of goods sold. So the price of these things will also go up. Now the problem is there is a big impact of this price change, this $10 and this $11. But we are ignoring this fact in comparison. We are comparing 2018 with 2019, but we are ignoring the fact of the price level changes. Suppose here also the sale is $1 million. So we are comparing this 2019 with 2018. But this comparison is not valid. This is not good comparison. Why? There is a big change. That is the price level change. $10 to $11. Or the cost of goods sold. The cost changes. But we are ignoring this fact. We are comparing 2 years. But there is a big impact of price changes and we are ignoring that fact. So we call it what? Ignores the price level changes. So price level, it changed. The prices from 2018 to 2019, there is a big difference in these prices, but we ignored these prices, these price changes. So this financial statement analysis will not be a good analysis if you ignored the changes in price levels. And keep in mind, in financial statement analysis, we are not focusing on the prices. We are just concerned about what? The total sales. In profitability analysis, net profit divided by sale. This is the formula. Net profit divided by sales. So in net profit divided by sales, we are just focusing on the total sales volume. We are not focusing on 11 and 10. So this is another weakness of financial statement analysis. The next one, the fourth one, it is financial statements are essentially interim temporary reports. What is inside the company is ignoring that fact. What does it mean? It means we are making financial statements at the end of the year. At the end of 2018, at the end of 2019. What is happening inside the company? We are ignoring those facts. So, financial statements, we are making financial statements at the end of the year. What happens throughout the year? We ignored that fact. What happens in 2019? What happens in 2018? Just at the end of year, we made these financial statements and we ignored what happens throughout the year. In the whole year, what is happening inside the organization, we didn't consider that thing. So, financial statements are essentially interim temporary reports. What is inside the company is ignoring that fact. So, financial statements are ignoring the fact what is happening throughout the year. This thing is ignored by financial statements, which is a weak point of financial statement analysis. The next thing, it is accounting policies. What does it mean? You know, sometimes we are using different accounting policies. Like one year, we are using straight line method. The other year, we are using declining balance method. So suppose in one year we use straight line method and the other year we used declining balance method, still we are comparing these two statements. Because when we are evaluating our performance, we are comparing the 2019 performance with 2018 performance. So here we used one policy, here we are using other policies. Still, we are comparing these two years. There will be a big impact of using different policies in different years. So because of this thing, comparison will not be good. So you can compare 2 years when you use the same accounting policies in these 2 years. Take another example. This is one company. They made their financial statements. This is another company. They made their own financial statements. This company, they are using one accounting policies, and this company is using another accounting policy. So comparison of these two companies, it will not be good. Why? Because of their different policies. There will be a big impact of using different policies in their financial statements, different accounting policies in their financial statements. So you can compare two companies if they are using the same accounting policies. Just like in the previous example, I give you the example of 2018 and 2019. In 2018, you're using one accounting policy. In 2019, you're using another accounting policy. So you cannot compare these 2 years. Same is the case here. One company is using one accounting policy. Other company is using another accounting policy. So their comparison is not good. But still we are comparing the companies, the performance of companies. We don't know what is their accounting policy. We don't know about that fact. But still, we are comparing the performance of Salam with the policy of Cardan. We are using, suppose we are comparing Apple with Samsung. We don't know which accounting policy they are using and which accounting policy they are using. Still, we are comparing these two companies, which is a weak point of the financial statement analysis. The sixth limitation of financial statement analysis is influence of personal judgments. Different analysts, they have different education level, they have different experience level, they have different mental levels. So one person, his analysis will be different, and the other person, his analysis will be what? Will be different. Suppose if I'm making an analysis and there is another person who have 20 years experience in financial statement analysis, there will be a big difference in my opinion and his opinion. So personal judgments are also affecting the financial statement analysis. So this is another weakness of financial statement analysis, that personal judgments are affecting the financial statement analysis. The last limitation of financial statement analysis is disclose only monetary facts. You know, accounting is concerned with monetary information. So in financial statements, all the information are monetary information. Not non-monetary informations are ignored. For analyzing the performance of company, we are just taking monetary facts. Non-monetary facts, we are ignoring those non-monetary facts. Employee welfare, employee benefits, employee motivation, all these things, we are ignoring these things. So because of that thing, financial statement analysis will not be a good analysis if we are only taking monetary facts and we are ignoring non-monetary facts of the organization. So since we are ignoring non-monetary facts, so this is a weak point of the financial statement analysis. So we discussed about the limitations of financial statement analysis. So one limitation of financial statement analysis is financial statements itself. There are weaknesses, there are limitations of financial statements. And when there are weaknesses in financial statements, we are making financial statement analysis on the base of financial statements, and financial statements are, there are limitations in financial statements. So financial statement analysis will not be a good analysis. Simple. You are analyzing a thing in which there are weaknesses. So when you made analysis, so that analysis will not be good. So there are weaknesses in financial statements, and we are making financial statement analysis on the basis of these financial statements. So this is what? This is a limitation of financial statement analysis. For this purpose, if you will study the limitations of financial statements, then it will be much more clear, because in I think second semester or third semester you studied financial statements. So there are these weaknesses. Window dressing. We discussed about window dressing. What is window dressing? Something is not good, but you are trying to show it good. The business is not good, but the decoration is good. Same is the case in financial statements. Financial statements are not good, but the accountant is trying to show them good. So when on the base of that window dressed financial statements, when we will make an analysis, that analysis will be a poor analysis. Ignores the price level changes. Just like I told you, there is a big impact of price level changes, and in financial statement analysis we are just taking sales. We are ignoring the fact what is the price in 2018 and what is the price in 2019. What was the price in 2018 and 2019? We ignored that fact. Financial statements are essentially interim reports. We are making these financial statements at the end of year. What is inside the company is ignoring that fact. The company, the financial statement analysis is ignoring that fact. In financial statement analysis, we know nothing about the whole year, what happened in the whole year, or what is inside the company. We know nothing about that. So this is also a weak point of financial statement analysis. Accounting policies, different years we are using different accounting policies, and we are comparing these 2 years. So it is what? It is a weak point. Or one company is using one accounting policy, the other company is using another accounting policy, and we are comparing these two companies. So this is a limitation of financial statement analysis. Influence of personal judgment. One person, his personal judgment is different. The other person, his personal judgment is different because of his qualification, because of his experience, because of his, you can say, IQ level. So different people will analyze the financial statements differently, which is a weak point of financial statement analysis. Disclose only monetary facts. In financial statements, there are only monetary facts. We are ignoring the non-monetary facts, which is a weak point of financial statement analysis. So I think for today it is enough. Inshallah, in the next class, then we will discuss about other things. Okay, have a good time.